Futures trading is risky and can result in substantial financial loss.
Good morning, good afternoon, good evening, traders from across the globe. Welcome to Short-Term Trading Live with Oscar. Is anyone left alive out there? Did you see these things come down in the last few days? Luckily, through analysis, we have been able to call this day after day. Knock on wood, we're like at a 30 days. I think we have 2 losing days out of the last 30. We have been really on with the analysis. And you know what? It's really not us. It comes out in these charts, traders. I have a series of charts I will run before your eyes in tonight's video. In fact, this is going to be a long one. I can just feel it coming out of me. So you better pull up a chair and a pencil and sharpen it and get ready to take your notes. Because I think there's a lot in these charts that you need to see. A lot of things have happened. Most of us know what's happened in the stock market. It's finally beginning to come down in a big way. You've had Bernanke speak. In his speech, he pretty much said, yeah, traders, we got some trouble, and we'll try and help you out of it, but it won't be easy, and it won't be quick. There's a stimulus package coming. You know, they've tried stimulus packages in the past. They've tried it 20, 30, 40 years ago. They tried it in the beginning of this decade, and you know what? It doesn't seem to work. Sprinkle a couple of bucks around the country, and everyone's going to run out and turn the stock market upside down. I don't think so. I think that the stimulus package is a good political thing to do if you're running for president or if you would like your party elected. Hey, look, here we are. The country's in trouble. Our party's going to help. I think it's more that than something that's actually going to turn our economy. The interest rates getting lowered will, in fact, give us the turn at some point. We will reach capitulation. We are beginning to ramp up the downside now. We are absolutely in a bear market. And it's really been exciting, traders. A bear market should be traded just as you would a bull market, only you are now a seller of rallies. And when it comes down, you buy back for profit. And when it rallies up again, and then you get in short, and when it comes back down, you try to buy for profit. If you are in a bear market going down, you should try not to find yourself looking to get long, hoping for a few points up, trying to play hero. Better than that, if the trend is lower and we are absolutely locked in a bear market right now, again, wait for the rallies, try to get short on some sort of a top-end rotation, and when it comes off, you should only be a buyer to take profit, or if your buy stop's getting hit. Myself, I haven't been a buyer in this market in days and days, and I don't plan on being a buyer. I plan on being the guy who sells rallies when the rallies present themselves. Try to keep that in mind, traders. Let's go to some charts in a moment. I want to show you why I think the stock market has come off technically. We'll give some projections, or at least I'll show you some projections on where we thought it would go. It is certainly on its way down. The Fed is going to lower rates. That's going to push down our dollar. It's going to push up gold. It's going to push up oil. And it's going to make the stocks have to go even lower. But there is a good side to this. I mentioned this in my last video. In the last video, I said basically what will happen is they'll push rates cheap enough so that really big companies that are healthy right now can borrow huge sums of money and start to buy up everything out there and merge with other companies. And when the big merges start becoming into a frenzy and you start hearing about a merger after merger and this huge company bought that company, we will begin the trading turn and likely capitulation will come. That big smash down, what I mean by capitulation, is at one point during this bear market, we're going to get a week of turmoil where the markets are going to drop so far, so fast. Everybody's going to be screaming bloody murder and saying this is the end, it's the crash of 29 all over again. And that will likely be when we finally hit our capitulation. When that happens, it cleans the clocks out, it cleans out the stops, we hit a bottom, and then the market can turn. I do think that lowering the interest rates will make that happen, but I don't think it happens like this. All right, traders, One quick thing I want to mention about tomorrow's trading, holiday trading. The markets are, some markets close early tomorrow being Friday, 1/18/08. Lots of markets will absolutely not be open on Sunday or Monday. So if you're a trader who can afford it and you've had a good year last year and you're having a good month, you are going to go away with the family or take some time or go to your cabin up in the mountains or whatever it is you do. But you have Friday, Saturday, Sunday, and Monday if you can take the Friday. Most people we know, or just about everybody's off Monday, and that usually means early on Friday, everyone's running for the exits, trying to get on the highway, trying to go out to wherever it is they're going to go, plan their 3-day weekend. And when everyone gets back on Tuesday, not everybody gets in on time. So because it's at a super major week, Christmas, New Year's type holiday, I'm willing to trade maybe the first half of tomorrow. And then I'm not going to trade again until most of Tuesday is gone. And maybe Tuesday afternoon when markets get back in line, I'll play there. So my advice to you is try and do the same. After the first quarter or first half of tomorrow's trading session is over, call it a day and go enjoy yourself for the next few days. And we'll all come back Tuesday and play this game again. All right, traders, keep that in mind. Holiday trading can be rough and tumble. I personally discount any of the trading that I see the day before and the day after a major holiday. Again, yes, it's a big holiday, but it's not the one where everyone's flying across the country, visiting family and such. So I will do a little bit tomorrow, and again, on Tuesday, not until after at least mid-session into the top end of the day. We have a red Omni again for the S&P. We have been calling for certain levels in the S&P. If you have been in my trading rooms, you will have heard me make a call on 1/12/08. No, let's take that back a minute. On, what would it be? I read the date today. It was like 12/12/07. I made a series of projections based on the formations I was seeing in the S&P market, and we called for 1343.5. We called for 1333.5. Got down to 1334 today. I didn't even remember the day I put that projection out, but luckily a lot of my traders keep track of everything I say, and they typed the date for me in my trading room and said, Oscar, you gave this to us a month ago. You told us we'd hit that level. We had an even lower projection, like down at 1277 to 1275, coming our way in the S&P. Well, we hit the 1333 level today. It was actually 1333.5, I think was the low, 1334. We came right down to that projection, which tells me that these markets are acting very technical. They're technically oriented. They're moving right down to the technical numbers, and that's pretty exciting, traders, because we're technicians. With that in mind, let's go to the charts. Let me show you what we got, traders. I think you'll find this very interesting. Okay, traders, before we get into the S&P, I want to show you something. On 1/12/08, the last weekend webinar that we did, I ran through a series of charts. In those charts, I mentioned that there are a few commodities left that have not doubled in price, and I venture to think that the fund managers who are out there that are looking to place money will certainly notice these markets and will put their money in them. And I mentioned coffee, sugar, cocoa, cotton, and I mentioned the meat markets. Those are the only markets left that have not really exploded in price. I put the CRB index up afterwards, and you can see that the grains, the metals, the financials, the currencies, they've all had a huge, huge rally, and that it's very difficult if you have a fund to want to buy such expensive commodities when there are a few left, a handful left that are inexpensive. So now we're going to look at some of those markets, where they were then, and that was literally 1, 2, 3, 4, 5, 6, 7 trading days ago, somewhere right around there, maybe 6 trading days ago. We looked at the charts, We realized that there was an imbalance, that these were too cheap. Now let's take a look at where they've gone since that video last weekend. Cotton. Cotton was trading 66.66. There you are, 6666, the 4 sixes. It was trading 66.66 on 111.08. We mentioned in the video, cotton has not come close to doubling in price. If I had to show you where it doubles in price, it wouldn't even fit on the price chart at that time. Well, since 66.66 a week ago, we've rallied up to 72.96. Wow. From 66 and change up to 72.96. And we had a slight pullback yesterday, or actually the day before. And yesterday on Thursday, it took off again and almost made another new contract high. So one of the charts that we looked at, the cotton is doing exactly what we expected. These arrows represent the day we mentioned it, and here we are today. Let's look at a few more. Okay, traders, next chart we're going to look at is the coffee market. The coffee has rallied 450 points since we brought it to light in the video that it was well underpriced. It has rallied all the way to here, from this level to this level, backed off for the last 2 days, and it looks like it's getting ready to go up for more. So I think the fund managers are looking at these markets, and it makes perfect sense to me that if these haven't doubled and just about every other largely traded commodity has doubled, well, then you would go for the coffee, sugar, cocoa, and so far, so good. Coffee up, cotton up. I think we mentioned maybe 6 commodities, possibly 7, that were able to be purchased. So far, 2 of them have gotten more expensive. Let's look further. Next on the block is cocoa. The cocoa market, we're looking at March now. These last 3 charts were March contracts. On this day where these arrows are, we mentioned that the cocoa was certainly not too expensive here, and it should go higher. Cocoa was 21.38 on that day. Is so far rallied 1,000 points. It's 100 points. It's 22.37. So far, so good. Cocoa is here. Now it's here. Very strong. I think that there's some validity to us realizing that these markets are underpriced in the way they're beginning to go. And there's a nice trend line here that they're following straight up, and it's almost been in parallel. Very, very smart. Market's doing quite well. Let's look at another one. All right, traders, here is one, the sugar. And if you remember that video, I said the sugar is probably one of the more thicker traded of those commodities, and the one that the funds would really look at. Sugar has gone from 11.32 right here when we mentioned it, as high as 13.09 today. As high as 13.09. Wow! I think the funds jumped all over it. On top of that, we had a great apex right here. Everyone knows my rule. I say at about the 70 to 75% mark of an apex, the market breaks out. You can see the apex here. You can see we got almost to the 75% mark, and away it went. So the market is absolutely working technically, and the fact that sugar is nowhere near doubled in price, it is still underpriced, and I think there's going to be more upside. And on the way up, we put in this nice little bull flag, as you can see circled right there. So these markets are trading very technically oriented, close to their numbers as we're expecting them. But the sugar market really has benefited from not being so overpriced as the grains and the metals and the currencies have become. So let's see what we can do. I think there's more coming on that market. Okay, traders, in that last series of charts, you see that they really are beginning to participate in this big rally that we're having in the rest of the commodities. The meats have not picked up yet, but they are probably the lowest volume, the least amount traded of all the commodities. So it takes a little more convincing, I would think, for fund managers to get in. but the meats are severely underpriced right now. They are the cheapest of all the commodities, so they very well may follow in suit. Now we're going to look at the big one, the big kahuna here, traders. This is the S&P. This is the head and shoulders that we have been talking about for weeks on end. And look at the way it is beginning to react out of that head and shoulders. We are now all the way down here. We broke out of the head and shoulders and have not looked back. This is what I was referring to earlier on our projections. I gave a projection of 1272, 1275, 1270, right in that area back in August. We are really beginning to drop now, coming right out of the head and shoulders formation, and down we're beginning to go. There's a nice couple of series of charts coming up next I want you to pay attention to, because you will see a lot of good things in there. Let's take a look at the next couple of charts here, traders. Okay, traders, now we are looking at the Dow. Last chart was the S&P March daily bar. Now we are looking at the Dow Jones Cash daily bar. Look at that broad head and shoulders, the breakout of the head and shoulders. We started to break down severely here. We ended up all the way down around the 12,159 level today. And if you'll notice, these charts are all running, holding their resistance lines very, very well. Straight down the resistance. They keep touching the line and breaking down, touching the line and breaking down. And if we extend this line out, you will see that it happened again. Very, very technical markets right here. You have to love the technical analysis. On top of that, we broke out of that major apex that we discussed at about the 70% mark and have not looked back. You had the head and shoulders, the apex, all the averages above it. You can't beat this, traders. The market is absolutely in a bear right here. If it does have rallies, those rallies need to be sold. But the point behind this is to just point out to you time and time again that a head and shoulders formation is a very solid formation to follow. And as you can see, the market's doing exactly what it should do coming out of the head and shoulders formation. Couple that with the apex and the averages all gathered above, and you have the makings of a very bearish market. Thank you, Fed, for helping it along, and let's keep going and see what we got. Okay, traders, next chart we're looking at is the Dow Jones Transports average, the daily bar, another indice market with the head and shoulders clearly defined, albeit not symmetrical, but still there. We have, of course, the apex. The market broke out of the apex and dropped, had a little rally, and interestingly enough, rallied up to this red line, which represents the bottom of the left shoulder, hits the red line, and starts to come right back down again. That is technical analysis in its purest form. You can't ask for more than that for a market to prove that it's trading technically. You have to love it. On top of that, once again, if you take a look at how well this market is just hugging its resistance line, the resistance line now comes in and intersects with the red line depicting the low of the left shoulder. That tells me you have resistance right up there between the 43.30 and 43.60 area. More like 43.45, 50, I think, is a closer measure. And that should probably keep us in check in the transports as we head back down again. So another indice market, the averages all gathering above it, breaking out of the apex, and of course the head and shoulders formation. Traders, please believe in that formation. If you learn nothing else from these videos, it is one of the best formations you will ever use. Pay mind to head and shoulders formations when they arise, and make sure you know how to take the measurements from them so you have projections and you know where we'll go next. Let's look a little deeper into this now, traders. Next, traders, is the Russell, the Emini Russell daily bar, the March contract. Look at this one. Another market that has come down, an indice market, after being in an apex. And interestingly enough, it broke the apex and went straight down, But not only is it in an apex, but look at how symmetrical this parallel trading is going on. It's trading right in between these parallel lines, up and down. So again, the technical analysis working well. Breaking out of the apex was the major move. On top of that, the next series of charts will begin to start showing you how one of our favorite averages that we like to use at the Emini Trading Academy seems to be absolutely accountable above the market where this one is and below the market where some on the next few charts will be. If you'd like to know what that average is, and we use it every day here, and all of our Omniacs seem to really realize that it's a fantastic way to call triggers on market movement, simply come on down to our site. It's www.livewithoscar.com. Come into our chat rooms, and I will be more than happy to give you the parameters on these averages. Wait until you see this purple average as it shows up in the next series of charts. I think you'll appreciate it. Okay, traders, now we are moving out from dailies to weeklies. This is the Emini Russell on a weekly. Look at that head and shoulders on the weekly, traders. It is clearly definable. It jumps right out at you. And when you have a formation on a weekly chart, it's twice as strong as what you find on the daily charts. So if the dailies have head and shoulders and they broke, and the weeklies have head and shoulders and they're just beginning, there's obviously more downside. More interesting than that is our favorite indicator, or one of our favorite averages. Here, the market came to test it and bounced. Pretty tough bounce there. Came to test it again and bounced. Came down only to hit the second average that we like to use here at the Academy. Rallied up, came down, tested the purple average again. Rallied up, came down, finally broke that average. And look at the down move we've had on a weekly chart. On the weekly chart, this average is absolutely a dynamo. And it has kept this market in check. And now that we're below it, that's where we will stay for quite some time. That's the Russell Weekly. Let's look at more. Again, traders, this is in a weekly chart. Now it's the S&P March contract, a weekly chart. Look at this same average I pointed out in the last chart. Held here, rallied. Held here, rallied, came back, held again, major rally, came back. Went to that second average, just as did the Russell. Took off again, came back down, touched the average right to the number, and took off. Came back down, hit the average again, took off, finally broke the average, and took us all the way to here. When you are above this average, you stay above it. When you get below it, the break gets severe. Now, on top of it, look at this. Shoulder, head, shoulder. Traders, do I need to keep pointing this out to you? It's amazing how well not only the formation works, but how often it's presented itself before the move. This down move in the indices has been telegraphed by this technical analysis, and we have been showing this to you for weeks on end. And finally, it's here. I've been following the analysis. I've been advising my Omniacs at the Short-Term Trading Academy every day that they should be getting short and respecting this head and shoulders and certainly respecting this average. And now it's happening right before their eyes. And what a fantastic lesson they have learned since they've met me and come to our academy. And you should do yourself a favor and do the very same thing. And come on down to our trading academy and let us teach you how to look at technical analysis in the fashion we do, because it has been quite fruitful for our traders so far. Now we're looking at the Dow Jones Industrials, the weekly again, traders, the weekly, and look at it. Shoulder, head, shoulder, massive break. What else do we have? Riding the average, gets below the average, has the big break. Here, we tested below the average slightly and jumped back up, and here again, just barely got under it, jumped right back up, but once we started to settle under it, the big crack came. Once again, one of our favorite averages at the Omni Trading Academy, working like a charm below the market. Let's look at more charts here. Okay, traders, today in my premium room, we traded NASDAQ twice. We did not trade S&P at all. And I mentioned to my Omniacs that we have something going on. This is the weekly NASDAQ bar chart. I mentioned to my traders that NASDAQ has the better value if you want to be a seller because it has not enjoyed the same drop that the S&P and the Russell and the Dow has. The NASDAQ is just getting out of the head and shoulders on the weekly right now. It's only here. It literally belongs down here somewhere. On top of that, you have a great trend line right here. The market has bounced off of it, big rally, bounced off of it, big rally, and is coming down for it now. That trend line puts us in the mid-17s. Wow. I'll say it again, in the mid-17s in the NASDAQ. That is a serious projection, and it looks like we should have no trouble getting there. As far as the average is concerned, it just kissed the average today on the big drop day that we've seen in the S&P and the Dow. The NASDAQ just touched that average. There is more room on the downside, especially on the weekly chart in the NASDAQ. Will we get a rally first? Of course you can get a rally in a bear market. Dead cat bounces happen all the time. But if it does rally, I will be the first one out there to try to call when the trading turn comes again, where we can get short and make our projection at least down here to test this trend line and have our third test of the trend line. Traders, most technicians out there know what happens after the third test of a trend line. Generally, A, it's valid, B, you break it. Let's see what happens with the NASDAQ. Let's look at another chart. Okay, traders, next on the block is the dollar index, but we've reverted back to daily bars, daily chart now. This is the dollar index, the March contract. I'm sure you know what I'm going to point out next, right? Shoulder, head, shoulder. 1, 2, 3. That looks good for the head and shoulders to give us the break to the downside. Then our average comes into play, and look at how the market can't get above it there and can't get above it here. On top of that, you have an apex right here, and we are at about the 65 to 70% mark, and we hit the top and started to falter. The dollar index, the Fed's about to lower rates. As the dollar index gets into a spot where it's near the average and hits the top of the apex and has a head and shoulders formation, that's about as bearish as you'd ever want it to be. I would imagine, I venture to think here, that the test of the upside of the apex will fail, and it will break down through the bottom side of the apex right here and head on down to the 75 area. The 75 area in the dollar index is an important area to hold, traders. I think it will begin to hold when we get there, but we are short-term traders, so I won't call that now. Once we're down there, we'll check the momentum, we'll check every other indicator, and we will see what we think. But for it to run into the resistance right now, as it's running up, running, possibly hitting some stops before the Fed makes its move, technically it makes perfect sense that the market is at the top of this apex now, so it can break the downside. Very interesting, traders. Let's look at one more chart here. Okay, traders, once again, we are discussing a weekly chart now. It is the CRB index, the weekly CRB index. Here's another one of our favorite averages here at the Omni Trading Academy. Look at how it holds it, rides the average all the way, holds it again, rallies up, comes back, holds the average, rallies, comes back, holds the average, rallies, comes back, holds the average, and then takes off for another spike. Now, traders, this is a weekly, and it goes in one direction. A weekly bar chart of inflation, if you will. It's the CPI, it's the PPI combined in one. You put those two together, they give you inflation. This chart gives you commodity inflation. And let's face it, you need the products inside of this booming bull market to create. You need the raw materials here to create products if you're a company. And if you're big enough, you're on the stock market. And if your raw materials are costing you this much, the price of your stock has to be going in this direction. This all makes perfect sense. It is why so much money is pouring into commodities and out of equities right now. And here is proof, and it's staying in a lovely parallel. And you know what? We are right about at the top of the chart. I'll have to extend my charts to show you higher levels of the CRB as we get there. That is very interesting, traders. This is a picture being painted by the technicals on the charts. We are artists. We're not scientists. I say this in many videos. Technical analysis is a fine art, and this is a picture being painted. And if you're into fine art, you should be able to take a look at that picture and give it a critique, right? Anybody into fine art can critique the pictures. Well, here's a painting. Let's see what you think of it. All right, traders, that's the chart segment. Let's go talk now. Okay, traders, so you've seen the charts. Did you see what that looks like? That is a picture being painted for you, traders. No doubt about it. These markets are talking to us, and if you want to learn how to listen to these markets, then you better get your butts down to our Omni Trading Academy, where we can teach you how to be a great technician and how to listen to these markets yourself. And you know what, traders? We're not about high-tech mumbo-jumbo. We break out our rulers like you seen me do. We use paper. We use rulers. We are the real deal. We look at what's really happening out there. We use no props. We use nothing to try to trick you into anything. We try to teach you the technical analysis I showed you on that board. And I'll tell you what, traders, it works really, really, really well when you do your homework. I think that with this holiday coming, you may get some sort of a bounce tomorrow. If I'm right, and a lot of traders are going to go on vacation, the likelihood is the market is susceptible to big down or big up. We're in a bear market, so big up it should not be susceptible to, but on thin trading, anything could happen. I don't know for sure what's going to happen, but you know what? I got a red Omni for tomorrow. I have an S&P trade set up. Remember, as I said in the beginning of this video, if it doesn't come early, I'm probably not going to trade the second half of the day. So if this setup doesn't come early, I'm canceling my orders and I'm done. Traders, the S&P, the ESH8, Omni says to sell it in the low to mid 1360s. And you know what? I did a little analysis right before this video, and it's not the low to mid 1360s. It's more like the high to mid 1360s, if you ask me. So take a look more in the high to mid 1360s for a place to possibly short the S&P. If it gets up there, get short, put your stop in a sensible place. If you don't know where to place your stop, just come on down to the site. Take a look at the Omni Trading recommendations. There'll be a stop there waiting for you. If you're not a member, get yourself a membership. I assure you, you won't regret it. So, the high to mid 1360s, you're going to sell. The market, I expect the 1320s, traders, the 1320s. If, in fact, it's not susceptible to a fund that comes in and says, hey, let's goose the market on the day before a holiday, then you should likely get into the 1320s or be out by the close. Remember, the Fed could strike at any time. That is the only wild card I see that could temporarily send us up. And even if the Fed strikes and the stimulus package comes out tomorrow morning, an up move is only going to be something for us to sell. So again, the 1360s, you're going to get short the high 1360s. The Omni Profit objective is the mid to low 1320s or be out by the close. That is a very interesting trade. Remember that the NASDAQ has not fully participated in this drop, so if it does begin to go, the NASDAQ's likely got some good downside coming. Traders, I know I say this often, but it really, really does help. Don't trade alone, traders. We have hundreds and hundreds of traders that come on down to our site. They hang out in chat rooms with us. I myself have cameras on me and a live microphone, and I coach traders all day long. And the beauty of it is this. You don't have to open up an account with our trading firm, no matter where your account is. We want you to just come down and hang out in our room. Don't trade alone. Hang out with the other traders. Yes, I would be your personal broker if you opened an account with me, but that's not what this site is about. This site is about teaching you how to be a better analyst. So don't be bashful. Come on down. It's a great place to hang out, traders. It is full of knowledge. We have lots of things there for you to take advantage of. We hold a class every day. And you know what's really interesting, traders? You see what I do with these charts that I just showed you a few moments ago? Well, during just about every day, if the markets aren't so busy I need to be locked in, I will lend my desktop out to every Omniac who comes to my site. That what's on my computer screen is now on your computer screen. I pull up charts, I do analysis, they hear me speak, they see me in the camera, and I teach them how to analyze these markets. And that is a class that you should be part of. Whether you are a veteran trader for 20 years or you just got started, there is something in that class for everybody, traders. Take my word for it. I've been trading almost 27 years now, and I learn from myself when I give these classes because there's just so much to learn. And technical analysis is something that is very, very, well, what's the best way? Redundant. You have to really be redundant in your studies. You have to look at it over and over and over. And if you see a head and shoulders, you got to watch it and measure it and look for head and shoulders in other markets. If you see a formation that is interesting to you, you look at the other charts in those sectors and you check for the same formations. And if they all have them, that is a picture being painted for you. Traders, we have loads of techniques to help you get that picture into focus. So make sure you come down and join us. It will be one of the best decisions you've ever made as far as learning how to do this properly. Traders, we have, I don't know, Mike, what's the number now? 259? 259. We are this close to 260 videos already prepared for you, full of techniques, full of lessons. We are here to help you, traders. I can't say it enough. If I just stood here and read some of the testimonials that our Omniacs write to us, we have stacks of them, traders, stacks of them, and they are elated with the amount of help and the amount of teaching that they are getting from our academy. So again, don't trade alone. Come join us. Let us help you out. Traders, always do your own homework. Always, always, always do your own homework. No matter what my charts say, no matter how I read them, you may be reading them completely differently. Do your homework. If your homework matches my homework, then think about taking the trade. I give recommendations, and you know what? You would be insane to take them, even from me or anybody else, without doing your own homework first. Believe in your own analysis. If mine lines up with yours, then you've used me as an indicator, which is what I want you to do. That's what this academy is about. We don't want you to follow every one of these trades to the T. We want to teach you how to come up with those trades for yourself. So you'll do your own homework every day. Make sure you do it. Send me your homework, traders. I am here every night going over my emails, and I answer everybody who sends me a chart. If you want me to look at your charts, send me a chart drawn up with your trend lines, with your analysis, with a little blurb written on it about what you think the chart means. I'll be more than happy to analyze that chart for you and send you back a message about your homework. And if you were in any other academy or any other school, you would have lessons all day and you'd go home and do your homework. We are no different. Do your homework. It will help you with your education. All right, traders, I think I've said about enough. I hope I've given you a clear picture of what looks like is going on out there. Remember those cheap commodities? You see what's happened already, especially the sugar. The spike is this big. It's a huge spike. They're looking at these cheap markets now, and you should be too. Traders, this is what we do. We are here to help you bridge the gap, and we try to do that every day. You know, there was a day when you had people down on the trading floors, and the trading floors ruled the exchanges, and they ruled the markets, and you can call a professional, and he would tell you what he was doing, what he thought would happen next, where stops were. That stuff is gone, traders. The floors are rapidly drying up, and operations like ours are the only place where you can get information and be with a crowd like that used to be, and we help you bridge that gap from the days of old to today when it's all done on computers and you have to figure out what to do yourself. So allow us to help you bridge that gap and come on down to the site. Now, I was just mentioning how many videos we had, but I never gave you the address where you can find them. If you don't come on down to our site, which is Short-Term Trading Live with Oscar, then you can go to our YouTube spot. It's www.youtube.com/Futures Analyst. And I'm getting the evil eye from Mike over here because I just gave you the wrong web address. But he's my editor, so he'll fix it. So, Mikey, when you get to that point, when you're editing, please fix that for me. All right, what else do I have? I think I'm all talked out for this video, traders. Again, I hope this helps you. Give me a call anytime, day or night, 702-629-4755. One last thing, place stops. A stop is your best friend. Always place stops and place them first. Okay, traders, the best thing I can give you as far as advice on mentality is this: keep your emotions out of trading. And one of the best ways to do that is to say this every day, and you know what that is. Stops are in. Emotions are out.
Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided. That being said, I am a 24-year seasoned trader on and off the floors. This is how I've made my living for many, many years. Good luck trading.